So in part one of the video, I talked about the fact that when you buy Amazon, you're buying 5 businesses into one. You're buying a retail e-commerce business, which is a market leader in the US. You're buying an advertising business that's bigger than Snap, Twitter, and even bigger than YouTube. You're buying a logistics business that has overtaken FedEx, going to overtake UPS. You're buying the cloud computing business AWS, which is bigger than Salesforce, Oracle, and even IBM. And you're finally buying a media business that's competing with Netflix as well as Disney Plus and HBO. So Amazon seems like 5 great businesses into one that's dominating almost every industry around us. But they've been showing very low profits in the last couple of quarters and negative free cash flow. And I said in part one that they're doing it deliberately. They're deliberately showing very low profits. It's all part of their evil plan. So I'm going to explain right now why. Why are they showing very low profits and how they could actually show huge profits once they choose to show their hand. And I'm also going to do a valuation of the business to find out if it's truly cheap or expensive. If you take a look at their net income statement, you can see again, revenue has been increasing consistently over the years, and net profit has been increasing, like I said, but net profit is very, very low profit margins. In fact, if you look at the profit margins, you can see that the net profit margins have been like 1.7%, 4%, 4%, 5%, 7%, which is very low. If you compare to other tech companies, their net profit margin is like 25%. Amazon's only like 5% net profit margin. What the hell are you doing, right? Other companies, their gross profit margins like Alphabet, like Google's like 50, 60% gross profit margins, but Amazon's gross margins are only 13, 14%. So why are their profit margins so low? Now, like I said, it is quite deliberate. They're doing this. So why are they doing this? Now, again, if you take a look at their net profit, again, growing but very, very low. And the last 12 months, there was a huge drop in net profit that freaked a lot of people out. Now, if they wanted to, they could show huge profits. They could show additional $40, $50 billion of profits if they wanted to. But they're not going to do that. Okay? So why? So what happens is that Amazon is actually extremely profitable. But instead of showing the profits, they are taking the profits and they are putting it back into the business, into R&D. So they're putting everything back into the business and not actually showing the profits. Okay, so you can see their R&D expenses have been growing insane, right? 35 billion, 42 billion, 56 billion, 61 billion. And out of this 61 billion, for example, they spend on R&D, about 30 billion are being spent on non-core projects. In other words, they're spending the money to build other businesses that are unrelated to what they're doing right now. So why is the company plowing back so much of their potential profits back into the business in terms of R&D? A few reasons. Number one is to constantly strengthen their dominant position and is to build their moat to eventually kill off all competition. It's like no one saw it coming that now they're going to kill FedEx, they're going to kill UPS. They could kill Netflix, they could kill off ad businesses, they could kill a lot of things, right? And all this happening because they've been building, again, their secret laser weapon, spending all their money. Now, companies could actually capitalize their cost and amortize them or depreciate them over 10 or 20 years. But Amazon is not doing that. They are expensing all their R&D and capital costs to artificially reduce their profits so they can reduce their taxes. Now, this is, of course, my guess. I think they're doing that. The bastards don't want to pay tax. Now, another reason is this. By showing very low profits in the short term, they don't attract the attention of regulators. Can you imagine if Amazon showed huge profits? A lot of regulators will come after them and want to shut them down because they realize that Amazon is beginning to dominate every single industry. So Amazon has got to be smart. They got to be quiet. They do it slowly, slowly killing everyone and showing that, I'm losing money. I'm not doing well. I'm a poor guy. So they're playing that evil card, but I can see what they're doing. And the moment they dominate everything, the moment they are number one in everything, and they have built their impenetrable moat, they will then show the profits. It's like, ta-da! And once they show the profits, their profit potential is easily going to double and triple or quadruple from where it is today. Now, just take a look at this, for example. Again, they are spending 60 billion on R&D. And again, out of that 60 billion, 30 billion are being spent on stuff that is not really improving their current business. It's on non-core projects, moonshot, long shot ideas. Now, if they wanted to, they could easily stop spending that money. All right, so they could easily add 30 billion to their bottom line right now if they wanted to. If they wanted to show the profits, they could do that, right? And they will do that, right? Once they feel that, okay, we're just going to show profits, right? So in other words, if you add back, right, 30 billion of non-core projects back into their operating income, that would increase their net profit from 11.6 billion to easily $41.6 billion net profit, easily, okay? So they could show this if they want to, they're just not showing it yet. They're not showing their ace yet, right? So if you take 41.6 billion and you divide that by the shares outstanding, that gives you an earnings per share of $4.09. So what does that mean? So again, let's go back to this. So right now they're showing earnings per share of $1, okay, which is a lot of bullshit, right? So they could potentially easily show $4 earnings per share this year. And of course, this is growing. Their profits are projected to grow at least 33% a year for the next 5 years. But you just take this year's earnings per share, all right, potential at $4.08. If you take the share price, right, the current share price is $116 as of yesterday. Take a $116 share price, divide by 4.08, what do you get? 116 divided by 4.08 gives you a PE ratio of 28 times earnings. So in other words, if you actually take their real profits, their PE should be about 28 times earnings. Now, some of you may say, but isn't that still very high, PE of 28 times? Remember, whether a PE is high or not depends on the growth of the earnings. Peter Lynch used to say that a company's PE ratio should be equal to its growth rate. So if the company is growing at 20%, their PE should be 20. If the company is growing at 30%, their PE should be 30. We call that the PEG ratio. Now, if you take a look at Amazon's growth, which is, like 30%, okay, then a PE of 28 times is considered a pretty fair price, right? Now, again, that is why if you just take the PE on the surface, it is very misleading to think that Amazon is more expensive than all these other companies. It is not, because their earnings are bullshit, basically, right? It's all being suppressed. A clue is if you take a look at the price to sales ratio, because price to sales ratio looks at the share price divided by the revenue per share. So that could be another comparison you make. If you look at price to sales ratio, Amazon's price to sales ratio is 2.5. If you compare that to Alphabet, 4.8, Microsoft 9, Netflix 3.5, Apple 6, then Amazon looks very cheap on the price to sales ratio basis. So if you believe that Amazon is a great business, does it make it a great investment? Well, it depends. I always say that a great business is a lousy investment if you pay too high a price for the shares. But a great business becomes a great investment if you can buy the shares for less than what it is worth, where you buy when it's undervalued. Now, of course, the trick is, how do you value a business like Amazon? It's not easy to value it. So I'm going to offer two methods of valuation. The first method is using a discounted net income method. Now, you can use a discounted free cash flow, discounted cash flow, discounted net income. In this case, I'm using a discounted net income method. Why? Well, because it seems to be the most consistent. If you take a look at their net profit, you can see it's been quite consistent: 3 billion, 10 billion, 11.5, 21 billion, 33 billion. So it's been increasing consistently. Now, again, the last 12 months, you see that big drop over there. I would not take that, right? I would take from the last financial year. Why? Because it was a last full financial year, number one. Number two, like I said, the last two quarters, the net profit was artificially skewed because of the mark-to-market loss in Rivian, which they bought this electric vehicle company. So the stock price went down. They have to mark-to-market the loss. So that skews the net profit. And also because of the huge increase in R&D to bring the profit down. So to kind of like get a more normalized net income figure, I'm going to use the last financial year, which is $33.26 billion of net income. And I'm going to project that income for the next 20 years. So unlike other analysts that use a terminal value, I'm going to just imagine the business is just going to generate profits for 20 years. Anything beyond that is a bonus, okay? Now you can see their cash from operations has been increasing consistently as well. Well, not as consistent as you can see, it's a bit up and a bit down. So I'll rather take net income in this case, it's more consistent. And it doesn't make sense to take free cash flow for the case of Amazon, because you can see that they are spending an insane amount on CapEx that has turned the free cash flow negative. Now, if you actually study the way Warren Buffett values businesses, he has often said that there are two kinds of CapEx: maintenance CapEx and growth CapEx. Maintenance CapEx is the CapEx required to maintain the current business. So you should deduct maintenance CapEx from cash from operations to value a business. But you shouldn't deduct growth CapEx. So if you take a look at Amazon, a lot of their CapEx is not maintenance CapEx. It is actually growth CapEx because they're spending billions to grow new businesses. So you shouldn't take that in valuing the current business. So that's the rationale. So I'm going to take 33 billion as my latest financial year of net income. I'm going to put in the total debt of the company, which is a short-term plus long-term debt, excluding capital leases, at 73 billion. Cash and short-term investments being held, 60 billion. Growth rate. Now, this would be, of course, the tricky part. If you take a look at Finviz, you can see their projected growth rate for the next 5 years is 33%. Now, what I do is I tend to look at different websites and I take an average of the different websites like Zacks, Guru Focus, and Finviz. So they are all projecting about 30%. So I'm going to take a 30% growth, especially coming from their ad business as well as their Amazon Web Services business. Now that's growing, in fact, more than 30% in the last 12 months, right? So take a 30% growth for the first 5 years, and then I'm going to halve that for the next 5 years and then tape off at 4%. They've got 10.18 billion shares outstanding using a 7% discount rate. So that gives me an intrinsic value of, tada, $191. That is my intrinsic value for Amazon. So as of yesterday, the share price closed at $116. That means currently, at today's market price, it is 39% undervalued. Now, what I like to do is, after I do a valuation, I like to look at other analysts, how they value the business, the stock, and I feel more comfortable if my valuation is lower than their valuation, because it gives me a bigger margin of safety, right? So again, I value the stock at $191. Let's take a look at Morningstar. If you look at Morningstar, you can see that their intrinsic value is 192, which is about my valuation, just $1 higher. If you look at Guru Focus, you can see their valuation is 194, which is $4 higher than mine. So you can see it's about that, right? That's roughly about the valuation, 190, 194. So we got a pretty good margin of safety for the stock right now. Now, another way to value the business, and this is a more conservative approach I thought I'll share, which is what I call the sum of the parts method. So in this method, I break Amazon into the different businesses, and I do my best to value the different businesses and add them together to get a whole valuation. And now this is a bit more conservative because usually the sum are worth more than the parts, right? But just to show you, okay? Now, if you look at Amazon Web Services, which is their cloud business, right? That's the first business. Their revenue projected this year, $71 billion. Now, this business has over 30% operating profit margin, so that gives an operating profit of 21.3 billion operating profit a year, okay? So what PE ratio do we assign to this business? Well, it's growing at over 37%. So we can use a PE of 30. That's in fact lower than the growth rate, which is conservative. Take a 30 PE of 21.3 billion. Amazon Web Services is valued at about $639 billion. So that's one business. Second business is their advertising business that competes with YouTube and Facebook and Instagram. Okay, so their revenue for this year projected at 40 billion. Their operating profit is 40 to 50% profit margin. I'll take 40% to be more conservative. That gives me an operating profit of 16 billion this year. Now, this business grew at 57% year on year, but I just take a PE of 30 times. That values the ad business at $480 billion. Next would be their retail business. Now, this is a bit hard to value, their retail business, right? Because again, it's being artificially, the profits are artificially low because they recently spent a lot on building their fulfillment centers, their same-day delivery, and so that has reduced the profits a lot because of the higher cost in the short term. So I thought one way to value it is to compare it with Walmart. In fact, Amazon is growing faster than Walmart in their retail business, so I thought it'd be a comparison. Now, Walmart is selling at 0.62 times their gross merchandise value, or GMV. So if you look at Amazon's GMV, gross merchandise value, it's 600 billion, not to be confused with their sales revenue, right? GMV is a bit different. So if I take 600 billion Amazon GMV, multiply by 0.62, which is Walmart's valuation, I get a value of 372 billion for their retail business. Retail plus e-commerce, all in, okay? Finally, their subscription business. This is where they make money charging subscription for Amazon Prime. People pay $130 a year, multiplied by millions of customers. Their revenue is 34 billion. Their operating margin, now this is not really clear on their financial reports. I'm just going to take a conservative 20% operating margin. That gives me an operating profit of 6.8 billion. And I'm going to take a 20 times PE on this. In fact, it's growing at 26%, but I'll take a 20 times PE. That values their subscription business at $136 billion. So if I add this to this to this to this, I get 1.6 trillion. That's the value of the whole business. So if I take 1.6 trillion, divide by number of shares, 10.18 billion, that gives me an intrinsic value of $159 per share, which is more conservative, which is even more conservative, right? So again, the first method, I got 191. Second method, more conservative, 159. Okay, but the share price at 116. So when you buy the shares at a price that is, way below even your more pessimistic valuation, that's a margin of safety. So as an investor, if you buy a great business, you pay a lot less than what you think it's worth. It's hard to go wrong. It's hard to lose money. Over time, the chance of making a lot of money is really, really high. Now, that doesn't mean to say that Amazon's stock price is going to go up tomorrow or next week or next month. It could still go down in the short term because in the short term, the market is driven by news, emotions, manipulation, and emotions, right? But over time, Amazon is going to compound in value, and that's why it's one of my bigger positions in my portfolio. Again, this is not a recommendation for you to buy it. It's just sharing my thought process as a value investor, how I select businesses to invest in. If you take a look at the long-term charts of Amazon, you can see that over the last 10 years, it has grown at 1,865% in the last 10 years. And over the last 5 years, you can see that Amazon has returned 130%. So that's roughly about 22-23% annual returns, which is pretty good, right? So I tell people, you know what? If it's a great business, don't freak out if the share price drops temporarily. Get excited that it's your chance to acquire a larger stake in a great business at a lower price, because your cash buys more shares at a lower price. So you can see that because of this current bear market, the price has come down in the last 1 year. And some people say, you know what, Amazon's share price has gone nowhere in 2 years. It's gone sideways. And that's precisely when people lose patience. They say, oh, forget it, it's a boring company, and they bail on it. That's why most people never grow their wealth, because this is the time the stock rests. When you find a great company, it doesn't go up all the time. Once it rests, once it builds that consolidation pattern and it takes off, that's when it starts a new run. So to me, I think Amazon is just at the beginning of another huge run in the markets. So if you take a look at the monthly candles and look at the longer term charts, you can put in the moving averages and you can see that we are pretty much at a support level. You can see my intrinsic value is 191, of course the really conservative 156. So currently again we're at about over 30% discount. You can see a previous resistance was there, previous resistance turns support. So this is a strong support resistance level that Amazon just bounced over, okay, and it's right below the long-term 50 moving average of monthly candles. So again, it could go low in the short term. No one can predict the future if there's panic selling, but I think the risk to reward at this level is pretty compelling. So that's my opinion. If you've got any questions, any comments, leave them in the comment section below. Hope you enjoyed the video, and I'll see you guys in the next one. If you want to catch my latest videos, click on the subscribe button right now. Click on the bell so you get instant notifications once I upload my latest video. If you want to check out my online courses, go to piranhaprofits.com. We're going to learn how to invest and how to trade the financial markets and create an income from all around the world. If you want to join my live Wealth Academy program, go on to wealthacademyglobal.com and find out more about how you can learn investing and trading live online. This is Adam Khoo, and may the markets be with you.